Hi, I'm Steve McDonald. I'm your host. Today, I'd like to invite you to become one of the well-informed here on our Wealth Survival Summit. Over the next few minutes, our panel of tax reduction and wealth preservation experts will show you powerful techniques for sidestepping the upcoming big government money grab. Perhaps more importantly, they'll also give you specific, actionable strategies for dramatically increasing your wealth, regardless of the politicians, the bureaucrats, and even the IRS. Joining us today from our nation's capital, Washington, D.C., are Dr. Scott Brown. He's a professor of finance at the University of Puerto Rico. Dr. Brown teaches finance to MBA and doctoral students from all over the world. He's also the education director for Investment U. Dr. Brown has spent his career studying the best tax reduction strategies and has now developed a comprehensive new program that can help you protect, preserve, and grow your wealth by becoming a forward-thinking investor. Jack Cohn, CPA. Your CPA may be a nice guy, but he's probably costing you thousands or tens of thousands of dollars. Jack should know. He's a former top IRS auditor and has seen massive tax filing errors and omissions few others know about, and has saved individuals and corporations literally millions of dollars. Today, this former IRS top cop goes to work for you and shows us the hidden fortune that's hiding in your 1040 forms. Bob Carlson's also here. He's the editor of the newsletter and website Retirement Watch. He's a managing member of Carlson Wealth Advisors, LLC, and chairman of the Fairfax County Employees Retirement System, which has over $3 billion in assets. He has spent the last year digging into the new tax laws, and he'll show us important action you'll want to take before December 31st of this year, so you won't have any unpleasant surprises when you file your 2013 taxes. Dennis Miller. Dennis is the editor of the KC Research monthly newsletter, Money Forever, and his own journal, Miller's Money Weekly. Working with KC analysts, Dennis advises subscribers on how to prepare a bulletproof retirement portfolio and ensure they'll have their own money forever. Today, he'll show us why the traditional old retirement investing strategies may not always apply anymore, and provide specific steps you should take to prepare for the new paradigm in retirement investing. Alex Green is also with us. He's the Oxford Club's investment director and a 30-year veteran of Wall Street. He says one of the most important factors in your wealth is how much you pay or don't pay in unneeded costs and taxes. Alex will show you how you could come out $50,000 to $300,000 or more to the good with just a handful of very safe and sensible changes, and it only takes about 30 minutes a year. I know Alex personally, and I know you do not want to miss what he has to say. Dan Mitchell. He holds a PhD in economics from George Mason University, has served as an economist for the Senate Finance Committee, and is a senior fellow at the Cato Institute. Today, he'll explain just how America got into this mess. He'll warn you about a very scary new tax that could throw our country into a tailspin, much like the European welfare states, and explain the tough choices politicians must make to save our country and your wealth from disaster. Okay, let's get right to it. I'd like to welcome our first guest, Mr. Dan Mitchell himself from the Cato Institute. Welcome, Dan.
Well, glad to be here.
I'm a big fan.
I appreciate that.
Tell us about the Cato Institute and what you do there, please.
We're a libertarian think tank, which basically means small government, free markets, and don't get entangled in messes around the world that don't affect America's national security. And I'm a public finance economist, so I spend my days banging my head on the desk as I try to fight high taxes, wasteful government spending, and as you can imagine, that doesn't make you very popular in Washington, D.C.
I know you believe this country is headed for trouble. Taxes, debt, out of control debt. Is there anything we can do to actually get this thing back on track?
There actually are very simple, maybe not easy, but very simple solutions. It's all about long-run trend lines. If government is growing slower than the private sector, then in the long run, you're going to wind up being in very good shape. But if you're like, say, Greece or Spain or Italy, and over time, government is growing faster than the private sector, then frankly, no amount of taxes are going to keep you out of fiscal trouble, as we've seen in one European country after the other. So the key thing is somehow capping, restraining, limiting, pick the word you want, but we have to figure out how to bend that cost curve of government spending down so that it's growing slower than the productive sector of the economy.
The worst part of this, and I know I've heard you speak many times, the worst part of this is getting worse, isn't it? It's going to get a lot worse.
Unfortunately, I wish I had a happy story to tell, but if you look at the combination of our poorly designed entitlement programs and the demographics, in other words, the aging of the baby boom generation, the combination of those two things is going to put us in a huge, huge fiscal mess. And it's actually beginning to happen right now, but basically the 2020s is when the you-know-what hits the fan, because you're going to have enormous increases in spending for Social Security, Medicare, and Medicaid. And the Congressional Budget Office just released its long-run fiscal outlook, and we're basically heading toward having a government that's bigger than what they have in most European welfare states today.
Well, Obama basically annexed the health care system.
Obama added to a mess that already existed.
Right.
Obamacare is very bad legislation, but so was Bush's prescription drug entitlement. And of course, the real problems began with LBJ, with Medicare and Medicaid, because the problem with these programs is not just that there's redistribution and things like that. They're so poorly designed on a structural basis that you create what's called a third-party payer crisis. Very boring, very intricate, but when you have 89% of healthcare spending in the U.S. financed by someone other than the consumer, of course you're going to have lots of inefficiency, lots of feather bedding, out of control costs, rising prices. It's predictable.
Let's talk taxes for a second. And I'm sick to death of hearing this administration talk about the rich not paying their fair share. What percentage of the tax revenues do the so-called rich, if there's such a thing, actually pay?
It's very slippery in Washington because, of course, are you rich if you're making over $200,000 a year? Are you rich if you're in the top 20%, the top 10%? All we need to know is that if you look at, say, the top 10%, they're paying close to 2/3, if not more than 2/3 of the income tax burden. Now, if you throw in things like payroll taxes, and then if you try to figure out how to distribute corporate taxes, that share drops a little bit. But overwhelmingly, the people who produce the most in our economy are footing most of the bills. And we're in a situation where nearly half of the population is not paying income tax. Now, that doesn't mean they're not paying anything, because they're getting hit by gas taxes, state taxes, property taxes, the Social Security payroll tax. But for a lot of them, they're getting things from the government. They're not paying for the government. And this sort of comes into that phrase you use, voting for a living. Right. You vote to have someone else pay for you to live.
Right. You brought up an interesting point, because when people think of taxes, they only think of federal income tax. But I recently left Maryland because of all the taxes that they not only increased, but created. We had the largest increase in just personal income tax in Maryland ever when this Governor O'Malley took over 5 years ago. So where's the breaking point? I mean, if you're getting whacked for 39.6% from the federal government, which the top producers are, state tax, gas tax, liquor tax, bottle tax, VAT, on and on and on, at what point is this going to break down? I mean, they can't milk us indefinitely.
I looked at some IRS data about what differentiated the so-called rich from the rest of us. Well, it turns out that rich people don't rely on wage and salary income. So, like, if the government raises my taxes, well, I'm at the Cato Institute. It's not like what am I going to do? Hold my breath and just close my eyes and stare and not work? I can't really respond much to changes in tax rates one way or the other. But if you make more than $1 million a year, 2/3 of your income is from non-wage and salary sources, business income, investment income. And if you have a lot of business income and investment income, you have tremendous control over the timing, level, and composition of your income. You can decide you're not going to work as much. You can decide to shift your investments into tax-free municipal bonds. You can do all sorts of things to delay, defer, avoid, evade taxes. And that's for the million and up. If you're 10 million and up, 81% of your income is from non-wage and salary sources. So rich people are not fatted calves awaiting slaughter by the government. But here's the problem. Back in 2008, and I think this is symptomatic of a lot of people on the left, back in 2008, Obama said that he wanted to raise the capital gains tax rate even if the government lost revenue. In other words, this punitive view of punishing success
That's exactly right, yeah.
trumped even the desire to have more money to waste.
Spending isn't going to go down. I think you and I would agree. Unless something radical happens in this country, spending's out of control. They can't continue to milk the middle, upper middle, and the so-called rich indefinitely. How are they going to deal with this debt problem? Because at some point we're going to be maxed out. Or can we be maxed out? I don't know.
If I had to make a prediction, I do think we're going to have a Greek-style fiscal crisis, and there won't be any IMF or European Central Bank or Fed or anybody like that to bail us out. Having said that, let me say something uncharacteristically optimistic, because normally I'm just, giving people bad news. For the last 2 years, for the first time in more than 5 decades, we've actually seen government spending reduced. In other words, we spent less in 2013 than we spent in 2012, and less in 2012 than we spent in 2011. We've actually cut government spending.
Real cuts, or we just decreased the percentage of increase?
No, normally in Washington, when they talk about spending cuts, oh, look, spending increased by 6% instead of 8%, so we did it 2%. No, genuine, actual, nominal reductions in government spending over the last 2 years. As a result, the burden of government spending has fallen from, federal government spending, has fallen from 24.1% of GDP to 21.5% of GDP, and the deficit, which I don't think is the biggest variable, the most important variable is government spending. But for those who worry primarily about red ink, in just 2 years, the deficit dropped from 1.3 trillion to 642 billion. Why? Because we actually controlled, indeed, we actually cut by a tiny amount government spending. And that gets back to what I was talking about before. It's all about trend lines. If we can sort of freeze government spending, you make progress very rapidly. And in the long run, if you can cap government spending, and that presumably means you have to reform the entitlement programs in an intelligent way, we can get out from under this mess. We are not, it is not preordained that America disappears into some sort of European welfare state fiscal quagmire. We can save ourselves, but here's the catch. We have to have politicians willing to do the right thing for the country. In other words, they need to be patriotic in the proper understanding of the words, doing what's best for the country, not what's best for themselves. I am terrified that American politicians at some point are going to figure out how to sneak a VAT through. That, in effect, is our Armageddon battle. If they get a VAT, I was just talking about, well, I'm sort of maybe optimistic that we can solve our problems. If the politicians get a VAT, we'll never solve our problems because they won't reform entitlements, they won't cap the growth of government spending, because just like the European politicians, they'll always figure, hey, we can jack up the VAT by a penny here, a half a penny here, and because it's such a broad-based tax, they collect so much revenue. Now, at some point, you still run out of money because the welfare state is paying people not to work and punishing those who do work. Right. So it doesn't, Europe is the example of what happens with a VAT. If that happens in America, well, then I guess it's stock up on bottled water, canned goods, and ammo.
I hope not. Let me throw you a little bit of a curve. If there were a VAT, that the revenues from the VAT tax could only go to reduce the debt, would you be in favor of it?
No, because I would much rather control government spending, reform entitlements, get rid of outmoded, unproductive, and inefficient government programs. So the answer to any question about fiscal policy is government should be smaller. We should cap the growth of government spending. If you ever put taxes on the table, it's like putting blood in the water with hungry sharks around. Yep. I mean, in theory, what you just described, well, maybe if we had a VAT, but they had to use the money for deficit reduction, I mean, it's like giving the keys to a liquor store to a bunch of alcoholics here in Washington. Yep. There is no problem that can be solved by giving more money to the 536 least competent people in America. That's the House, the Senate, and the President.
I love it. Is there anything, and I mean in practical terms, I know if certain things happen, we can turn this around, but in practical terms, is there anything that can really be done to get us out of this mess? And the second part, can the average person, who's really the victim of this, the guy out there working, the couple working, raising kids, paying their bills, is there anything they can do to prepare for the new taxes that are coming?
As much as I think politicians are too short-sighted and not doing the right thing, the House of Representatives for 3 years in a row has passed a budget that does include structural reform to Medicaid and Medicare, which are unquestionably the two biggest long-term drivers of our potential bankruptcy. So yes, every so often, these guys will do the right thing for the right reason. But The Senate hasn't done it. Obama, if the House and Senate did do it jointly, Obama would veto it. So at some point, whether it's 3 years from now, 7 years from now, at some point we need these reforms to happen if we want to save the country.
I love your thinking. Thank you so much for being with us.
Oh, it's great being on the program.
Thank you. Now I'd like to introduce Dr. Scott Brown. He's a professor of finance at the University of Puerto Rico. He's education director for Investment U, the education division of our own Oxford Club. And he's one of the most knowledgeable guys on the face of the earth when it comes to the U.S. tax system. Welcome, Scott.
Hi, Steve. Actually, it's my team that's the most knowledgeable on the planet when it comes to taxes.
Well, we only have one chair, so you're on the spot.
Okay, good. So I'll be the tax expert.
This webinar was your idea.
Yes.
And there's an urgency about this that I don't understand. We've had taxes forever. They've always been a problem for me. Why now? Why do you have to get this out now?
Well, because the U.S. fiscal system is distorted by the politicians. The politicians use the system to fund their re-election campaigns and so forth. We've seen enormous problems in the economy, ranging from bank bailouts and so forth, that have to be repaid somehow. And so what we're seeing is both state and municipal governments that are going extremely aggressively after taxpayers to pull whatever taxes they can out of the taxpayer.
Now, this is not just academic for you. This is almost a crusade, isn't it?
Absolutely.
It's personal, at a personal level?
Yeah, absolutely.
Can you tell our viewers about it? Because I know, and if you can, not get too hot about it.
Yeah. Yeah, actually my accountant, Jack Cohen, CPA, actually asked that I start to tell the public about this. I was really quite embarrassed about it. What happened was when I was 19, my father was diagnosed with throat cancer and died in my second year of biochemistry and biology at Indiana University. And the money stopped. He died. My father was a very wealthy optometrist. And what he had done was he hadn't taught my mom how he was basically evading taxes. He had two different sets of books. He knew that I had the intellectual capacity to receive a doctorate and take over the practice, and he was grooming me to take over the practice. The CPA who had been helping him hide roughly about half of the revenue in the practices was disbarred that year. And in the exact same year, the attorney that did the estate planning was also disbarred. And in the havoc that followed, my mom lived in the hospital for 6 months to support him, and by the end of 6 months, she was drinking a gallon of wine a day. And everything collapsed. Our whole world collapsed. And money stopped coming in to help me pay for rent and so forth, and I was evicted. And so I ended up living in my pickup truck for a period of time.
Let me stop you for just a second. Was this driven by the CPA?
Yes. Well, it was driven by two factors. It was driven by the CPA, and so the CPA called my mother and informed her that she was very likely to be hit with an audit and that he wouldn't be able to defend her, which is really devastating because as I teach in this program, the degree to which that you're going to succeed in terms of not paying taxes is largely driven by the quality of CPA that you have. The vast majority of CPAs and tax preparers will throw you under the bus in an IRS audit and just roll over and say, okay, whatever, agent, I'll just get the client to pay.
Is that what happened to you?
No. As it turns out, she was surprisingly not audited, but because of her terror of an IRS audit, she went on a spending spree and completely wasted the entire family fortune. It was a multi-million-dollar family fortune. And because of the disbarring of the estate attorney, she was able to access money that had been tax sheltered, and just basically completely destroyed the entire fortune through financial mismanagement.
You talk about something called a tax-advantaged life. In fact, you've been teaching people what a tax-advantaged life is and how to do it. Can you talk about that? Tell us how people can actually become involved in it.
I don't think there's anybody on the planet that hates taxation more than I do because of the experience I had at an early age. And so so I found myself in a situation where I was capable of getting through very difficult material in university, but no longer had any motivation to continue in healthcare because the practice was gone. My family was destroyed. So I ended up going to Thunderbird International Business and then on into a PhD in finance. And the reason that I ended up going in that direction was because I ended up developing a burning desire to master money. You know, I think one of the things that just makes me smirk is when people say, money's not important. And I stare right back at them and I say, look, money is the most important thing in
Money
your
can't
world.
buy happiness, but I'll take my chances.
No, money does buy happiness.
Yeah.
Let's clarify that. It does buy happiness. So so people need to take this stuff, this money stuff, seriously. There's things that I don't like about money. There's things I like about money. But it's like driving a car. There's things I don't like about driving a car. I don't like traffic and stuff. But I have to train myself well to be able to do that particular task successfully. And it's no different.
But let me interrupt for a second. The way the government's coming at people now with these new taxes, can you actually do a tax advantage system?
Oh, absolutely. In fact, it's interesting because Jack Cohen, who's a former IRS agent and winner of the David Bernard Award, the highest award in the IRS, we were just laughing about it in Las Vegas about how the IRS has just completely ramped up the amount of audits, and the stuff that they're coming after is absolutely ridiculous. And the thing is what's going on is that the politicians in Congress have bankrupted the system, and now they're going after the middle-class taxpayers to suck whatever money they can out of their rear end to pay for the fiscal mismanagement.
Is there anything they can do about it?
Yeah, absolutely. There's massive things they can do about it. There's things that can be done in the short term that can be done right now, over a period of a couple of weeks. And then there's other things that can be done over an intermediate term of a few years. And then there's even more powerful things that can be done over periods of a couple of decades.
We're going to come back to you in just a second, but if you would, please, would you tell us a little bit about the people that you've chosen to be on this program today?
Yeah, the guests we're going to have today are the best people that I have identified in terms of teaching you to become tax advantaged. My personal CPA is first and foremost on my team because it took me multiple decades to find him. You have to remember that I'm a finance professor and accounting professor, a lot of people don't know that, at a major state university, the University of Puerto Rico. We produce, there's 4 million people on that island, and we produce 65% of all the CPAs on that island. And I know all the faculty, and I know all the major CPAs. In other words, I don't think there's anybody in the Oxford Club that knows more CPAs than I do. And I've rejected every single one of them except Jack Cohen.
See, he's one of our guests.
Yeah, absolutely, okay. Absolutely. The other members are either tax attorneys or other experts who also understand additional aspects of the tax-advantaged lifestyle that I myself have benefited from. I had a glorious experience last year. I had a glorious experience. I was audited by the IRS. Now, that may
Always
sound
fun.
No, this was fantastic. I was really nervous at the beginning, right? I called Jack's office, and his receptionist said, "Well, if he hadn't called you, there's no problem." Well, a couple of weeks later, I get a letter from the IRS, and I captured $430,000 of tax loss carryforwards in winning that audit. And I couldn't believe it because there's no other CPA that could have done that for me.
Well, let's do this. Let's bring him on. The Jack Cohen's coming in from Las Vegas. Welcome, Jack. What should our viewers know about taxes that they won't learn from your typical CPA?
Well, I think the biggest problem that I've seen over the years, or at least since I've worked on in the private sector, is the fact that there's not a whole lot of communication that goes on between clients and CPAs, and unfortunately that leads to a bad result many times. Most CPA firms, while they may be quite competent, kind of have a factory mentality on how they deal with clients and tax returns. Their mission is to basically get your tax returns done as quickly as possible, so pretty much you quit calling the office and asking, are my tax returns done? And so I think during the rush of tax season many times that many firms are more concerned with getting the returns done than actually getting them done correctly. And so I guess what I'm trying to say maybe is that you kind of have to have a looking forward approach versus a looking back approach. You know, when you get your tax returns done, sometimes it's a little too late to do something for that year, but certainly that should be the impetus to try and do some planning and do some strategizing so you can improve things for the next year.
Jack, can you give me a couple of examples of recoveries you've made from your clients by finding errors and omissions?
Well, let me just say that it's part of when we get new clients, what we'll routinely do is we will be following up other CPAs who've already done clients' tax work. And again, many times, I'm not saying every time, but many times, if we find errors in what I would consider to be strategy, meaning that their structure wasn't set up correctly in order to have them pay the least amount of taxes, and many times we find out and out errors on tax returns. in my opinion, stuff that shouldn't happen, but happens on all too frequently basis.
Right. Do you have another example of something like that?
Oh, sure. In fact, Dr. Brown had referred a client over to me. It was a California client that happened to be under audit by Internal Revenue Service. And of course, as I mentioned earlier, we do a lot of representation work, and we agreed to represent this client, and he had a fairly decent sized company. And in looking over the client's prior year tax returns, we basically found some, what I would consider to be gross errors on the returns. And as it turns out, we actually got this client back about $73,000 in tax, and that was before the audit even started.
So is it smart to trust a CPA to find all the deductions and credits, or does the taxpayer need to be more involved?
Well, I think that the more involved that the client is, I think, ends up with a better result. Because a lot of times things happen that clients don't think anything of. They don't think that there's any tax significance. And as it turns out, from talking with them, it does. I mean, we've had many clients that had lost money in real estate, lost money in other investments. They had invested in other companies that basically just didn't think twice about it and just figured that the money's gone, never realizing that there was a huge tax impact to having lost money.
Right. Well, a question we hear a lot is that many people are interested in creating small businesses or LLCs for side businesses, hobbies, etc. Can you legally turn your side business into a tax haven? Is it possible?
Well, first of all, let's start back a little bit. I think that anybody that's going to be in business today, whether it's a side business or your major business, should really be set up as a corporation. People smarter than me a long time ago have thought about this. You know, years ago, people incorporated not because they thought that they were going to get sued, but they thought, what happens if I go bankrupt? And you don't want to lose your personal assets. So people incorporate for two major reasons. One, they want to basically set up kind of a wall between their business activities and their personal assets, so in the event things go bad, they don't lose their house. And the other stone cold fact is the fact that corporations get a better deal on taxes. And again, that's not something I invented, that's just the truth. But why should someone want to start a side business and be a corporation? Well, again, a couple reasons. One, for liability reasons. Number two, for tax reasons. And as it turns out, corporations actually can get more deductions than you can as an individual person. There's another great reason for incorporating your side business. Statistically, the IRS audits far less business returns than they do personal returns. And so every year the Internal Revenue Service does a study on how many or the types of returns that they audit. And as it turns out, that when people file partnership returns, subchapter S corporate returns, and C corporate returns, the audit selection rate is about 0.5%, as opposed to your individual 1040, which could be as high as 5 to 6%.
Right. Now, another one, and I know the folks watching are going to love this. Can you turn your active investing into a business, and is there any tax advantage?
Can you turn your active investing? Well, certainly if you want to consider yourself a full-time trader, day trader, think about it. There are so many tax advantages to be considered a full-time trader over a regular investor, and of course that's the major reason why people want to do that. An easy example would be if you were just a normal investor and you lost money in the stock market. For tax purposes, your losses are limited to $3,000 a year. So if you happen to have a really bad year and you lost $100,000 and nothing else happened, you'd have to go 33 years before you're able to use up all the losses. Well, if you could be treated as a full-time trader, you get to write off the $100,000 loss at one time. And that's just one of the many advantages that you can get by considering yourself to be a full-time trader.
You can take the whole amount because you set it up as a business.
Correct. You set up a corporate entity and you treat yourself as a full-time trader. That's exactly right, Steve.
Give us a couple examples of recoveries that you've made for clients by finding, as a result of errors or omissions that you've found.
Well, like I said, I mentioned the one earlier I had mentioned where the company was under audit. Basically, the accountant, a California accountant, didn't understand net operating losses in California. They didn't understand alternative minimum tax. And here's what happens. And I understand, but I don't understand. Tax software is great software, except that it's still a garbage in, garbage out system. And so no matter how you input the data, when you're done the tax return, you have to be able to step back and look at the return and know, does the return look correct or not? And in that earlier example, the alternative minimum tax was off by a significant amount of money. The net operating losses in California were off. And so the tax software said the return was done correctly, but of course it wasn't. Another great example, and most commercial tax softwares get this wrong all the time. People who have investment property that sell it. Tax software will routinely miscalculate how gains on the sale of real estate is calculated. And the software would have you believe that it's done correctly. But the truth is it's done incorrectly.
Jack, thank you so much for being with us. Is there anything else you'd like to add before you go?
I guess my poster child case is we had one client that owed the Internal Revenue Service $1.4 million for many, many years. And we actually settled with the IRS for $16,000. And he didn't even have to pay the $16,000 at once. How do you like that? He was allowed to pay it out over 2 years. And so I just think that most CPAs, as smart as they might be, just don't have that in-depth experience of having worked for the IRS. And I think that kind of puts the clients on a level playing field with the Internal Revenue Service, something that they could not have had before.
Well, in just a moment, we're going to tell our viewers how to get in touch with you. But for right now, we've got to bring on our next guest. But again, I'd like to thank you, Jack Cohen, for all your great insights today. Thank you so much.
Thank you very much for having me. I really appreciated it. Thank you.
Our next guest is Bob Carlson. He's been an attorney since he graduated from the University of Virginia School of Law. He's appeared in the Wall Street Journal, Barron's, the Washington Post, and many more. He's editor of the newsletter and website Retirement Watch. And you're a private pilot too, Bob. That's pretty impressive. And that's especially impressive coming from a Navy man.
Thank you, Steve. Glad to be here.
Let's get right to the tax issue. The recently passed so-called American Taxpayers Relief Act is going to cause a lot of heartburn for a lot of people. But before we get to the gloom and doom, there's some good news in this, isn't there?
Well, the good news is that the Bush tax cuts of 2001 and 2003 were set to expire, and this law prevented them from expiring. If we hadn't passed this law, tax increases would have kicked in all across the board, and we would have gone back to the 2000 tax law. So it was a big benefit to a lot of people, despite the tax increases that are in there.
Okay, one of the taxes that's coming down the pike, and everybody's going to get hit with this, is from the Affordable Care Act, Obamacare, if you will. Can you talk about what it's going to be about?
Right. This is one of the little-known taxes people are just finding out about. To pay for Obamacare, they imposed what's called a net investment income tax. It's 3.8% on your net investment income. It's in addition to all your other taxes. So you'll pay ordinary income tax or capital gains tax, and on top of that, you'll pay this 3.8% tax.
Where is this going to hit people the most?
It's going to hit all types of investment income, of course, interest, dividends, both long-term and short-term capital gains. But it's also going to hit people with rental income. It's going to hit people with some commodity trading. That's a very complicated section of the law, so if you have any commodity trading gains, you need to talk with a tax advisor. It's going to hit also REITs, real estate investment income.
How's it going to hit REITs?
They distribute investment income. And so if you receive income from a REIT, that's going to be part of this tax. Also, some master limited partnership income is going to be taxed.
In addition to what they're already paying?
Right. It's an additional 3.8% tax.
Is this going to hit the so-called rich or the higher income people only?
It's scheduled to hit married couples with adjusted gross incomes of $250,000 or more, or single people with $200,000 or more.
That's not rich.
It's not rich, and people who are also not rich will still hit this tax, because if your regular income is below those levels, you still might be hit with this tax if you have one big-time income boost. If you sell a large investment asset, a piece of real estate, something like that, it'll push your adjusted gross income above these levels, and you'll pay this tax on all your investment income for that year.
Is there any way around this, any way to avoid these?
There are a lot of ways. Your main goal is to reduce your adjusted gross income. That's the number at the bottom of the front page of your tax return. So your itemized deductions, mortgage interest, charitable deductions, those don't count. And that's what fools a lot of people, is they don't realize it's what's on the front of your tax return that counts for this tax.
What, between my gross income and adjusted gross, what comes out?
Well, there's not many deductions, so you mostly have to look for ways to restructure or eliminate the taxable income. You can restructure income in some ways by, say, moving taxable bonds into tax-exempt bonds. You can...
So you can't have the income show up at all?
Right.
Not as taxable income?
Right. You want to move from income that's taxable under this tax to something that's tax-exempt.
This seems like a complete shift in thinking. I mean, my entire life I thought deductions, mortgage interest, something, business deductions, office at homes. This is not the case anymore.
Well, Congress is getting clever about this. It realized that it imposes these taxes and people just look for deductions to offset their income. So it's bypassing the deduction part of the tax return, and most of our new taxes are being imposed based on your adjusted gross income rather than your taxable income.
Would it be true to say that the average guy now, not the wealthy, but they're going to have to start, the average guy is going to have to start thinking about taxes more than they ever have in the past, the way the so-called rich have for years?
Right. Your average taxpayer is going to have to be more sophisticated and use some of the strategies that rich people used to use, that have been using for years. You're going to have to look at strategies such as moving or converting one type of income into another type of income. You can't just rely on taking tax deductions the way you used to.
What kind of changes are we talking about?
Well, you want to restructure your income. Rather than focusing on your deductions, focus on your income. One example we already discussed was moving from taxable bonds to tax-exempt bonds.
Well, let me stop you there for a second. I recommended tax-exempt bonds for years, but you had to be in such a high tax bracket to make that worthwhile. You're saying that no longer applies?
Right. Many people below the top tax bracket will benefit from tax-exempt bonds now, partly because of all these other taxes.
Sounds like a good place to be selling tax-exempt bonds.
It's a good deal for them right now. Another thing you want to look at is holding your assets in the right type of accounts, such as holding some assets in taxable accounts, some in tax-deferred accounts. Alex Green is going to discuss this in more detail later, and that's good because it's a very important issue going forward.
The new taxes that are coming, what parts of it are not getting the media attention that people need to know about?
Well, there are a number of things that are not getting headline attention people should be looking at. One thing in particular is people who looked in the past whether or not to convert a traditional IRA into a Roth IRA should reconsider that. And that's part of a bigger picture of reversing the long-term rule of deferring taxes. The long-term rule was you want to defer taxes whenever you can.
Until you get to a lower tax bracket.
Right. But it looks like that's not happening anymore. Older people are the people who have the most money. Congress knows that, so it's imposing taxes on them. So you can't say, I'm going to defer taxes now because when I retire, I'm going to be in a lower tax bracket. Odds are you're not. When you add your regular tax bracket, these new taxes, the taxes states are adding, you're probably going to be in the same or a higher tax bracket in the future than you are today. So it makes a lot of sense in many cases to pay your taxes now and then set it up so you're going to have a lower taxable income base in the future. Put it in Roth IRAs, put it in taxable accounts, and invest for long-term capital gains, things of that nature.
Is this going to wipe out the whole concept of short-term trading or short-term profits?
Short-term trading is very dangerous from a tax aspect because you're paying ordinary income taxes plus this investment income tax on all those gains. If you do it through a tax-deferred account, you'll be deferring those gains, but when they come out, there's still going to be ordinary income taxes, and it's likely to be at a higher rate than it is today.
Any other aspects of the new tax laws that people need to know about?
Yes, there's quite a few. They're very complicated. People need to know about them. We prepared a report on that. I've contributed it to it. Some of the others have, and so they can get it just by viewing this presentation.
We'll get that information to everyone later on. I want to thank you so much for being with us today.
Thank you, Steve.
It's been our pleasure. And now I'd like to introduce our next guest, Dennis Miller. He's going to give us a closer look into the new retirement paradigm. He's the retirement specialist at Casey Research. He's been a successful businessman for a 50-year career and is now the editor of Miller's Money Weekly. Welcome, Dennis. I understand you're also doing some writing for MarketWatch, and they refer to you as a retire mentor. What's that all about, and how can you mentor those who might be looking for help?
Well, it's kind of interesting because I'd never heard of the term retire mentor before, but when you think about it, Steve, as we go through life, most of us have been fortunate enough to have a mentor along the way, somebody that's a little further along the path of life that maybe we can learn from their experiences and make our life and our journey a little bit easier. What I found interesting with MarketWatch was I'm the only retire mentor that they have that's actually been retired. And what I'm finding is something interesting. You know, I've been an Oxford Club member for a lot of years, and Oxford Club and Casey Research both are dedicated to help people acquire wealth and then keep that wealth so that they can enjoy it for the duration. And what happened was, in the fall of 2008, when the government decided to flood the banks with money at the expense of seniors and savers, the whole investment paradigm changed for those who were concerned about retirement. And actually, Casey Research convinced me to come out of retirement to put together our Miller's Money website and our newsletter to help people that are trying to retire understand just how the entire investment paradigm changed virtually overnight.
Can you explain for our viewers what you mean by the new paradigm for retirement investing?
Well, it's kind of interesting because several things converge together and almost all at once. Employee Benefit Research Institute conducted a survey, and they found that only 3% of the people that have retired from the private sector have a pension. And that over the last 25 years or so, employers in the private sector have unbundled themselves from the pension concerns and gone to some sort of a 401k or an IRA program. Now, bring one more factor in, and that is our generation, Steve. It used to be very simple when you talked about retirement. It was 100 minus your age. So if you were 65 years old, you'd put 65% of your net worth into CDs or treasuries, and the other 35% you'd put into the market in order to keep up with inflation. Well, that changed in the fall of 2008. Now you can't get any high-quality fixed income investments that even keep up with inflation. So couple the two together. You have generations of people now whose responsibility is for retirement is their own, and they're going into an investment climate where all the safe things like the CDs and the treasuries aren't even going to keep up with inflation. So they are now having to learn how to invest in an entirely different world.
So what kind of first-hand advice do you have when it comes to this new paradigm for retirement investing? What should people be doing?
Well, you know, the purpose of this webinar is to talk about taxes and tax strategies. And my concern is, you know, while we might want to be talking about new rules as far as taxation is concerned, I think the first thing you have to be able to do is you have to accumulate wealth in order to be able to invest it. And there's a lot of tax savings that are available to us today that we really need to emphasize to people concerned about retirement that they really take advantage of. You know, every dollar that we put into a 401k, a traditional 401k, a traditional IRA, the amount that we save actually comes off as a deduction on our income taxes. And I don't think people really understand that. If you're over 50 years old, for example, in a traditional 401k, they have what they call a catch-up. So a 50-year-old person can actually save $23,000, put that money into their 401k program. Now, if they're in the 30% tax bracket, that's $6,900 worth of tax savings in the year you put the money into your savings. Think about that for a minute. The government's saying, we'll give you a $6,900 tax break if, in fact, you put $23,000 away for your retirement. And, Steve, here's what really concerns me. Employee Benefit Research Institute tells us that only 10% of the people that they have surveyed are maximizing their contribution.
The traditional advice has always been to let IRAs grow and defer the taxes, but that's not your approach. Can you explain why?
Here's my position. When you have a traditional IRA, when you have a 401k, you have a business partner. And that business partner is the government. And the sooner you can buy out that business partner for the least amount of money, the better off you're going to be. And I always ask the financial planners this question, Steve. Can you guarantee me that taxes aren't going to go up? When they're telling you to hold that money in there, they're basing things on assumptions. And one of the assumptions are that the government is not going to raise taxes, particularly on the wealthy. When I rolled my traditional IRA into a Roth, I was in that envelope of the temporary Bush tax cuts, and I had to pay the taxes at that rate. Well, since that time, the top tax bracket has already gone up 10%, so that keeping that money in there, you're risking that the government might just go from a minority business partner to a majority business partner. Once it's in the Roth, it's tax-free.
Well, that makes a lot of sense. So what do you suggest people do with their Roth over time?
That's a question I get asked a lot. And when you really understand the concept behind an IRA or a Roth IRA, what I recommend is that you put it into one that we call self-directed. Now, you have to keep it in that Roth for 5 years. Now, personally, that's the last part I want to touch. I hope my Roth is 25 years old before we have to touch it. But you go into a self-directed IRA, basically, you really have several advantages. A lot of people put their IRAs with what I call the captive houses, the Fidelities, or places like that. And they require that you invest in their products. Well, sometimes their products aren't the ones that are right for you, and sometimes their products have some pretty high fees associated with it. Where my Roth IRA, I am self-directed. It's in my online brokerage. I trade with a click of a mouse. I have some Oxford Club picks in my portfolio, and I trade it just like I've always traded. So I don't have to invest in anything I don't want to.
Interesting. Where did you put the Roth?
Well, actually, I broke my Roth up. I took 1/3 of it and put it into an account with my online brokerage where, I can trade it with a click of a mouse just like anything else. And then I actually took the other 2/3 and sent it offshore. I've got a money manager in Switzerland who's looking after it, investing it internationally for me.
Interesting. And speaking of Switzerland, does the government regulate foreign bank accounts?
I don't know if the term regulate is right. One thing they do try to do, however, is to scare people. If you're investing outside the U.S., you're either a tax cheat or a drug dealer or something, and nothing could be further from the truth. And that I know this is something that Oxford Club is very strong on as well, is investing internationally. So don't let the government discourage you from doing what is perfectly legal, and in a lot of cases, what's in the best interest of you and your family.
Well, this has been great. Thank you so much. Dennis Miller, our new Retire Mentor. Thank you, Dennis.
Thank you very much for having me. As I said, I've been an Oxford Club member for a long time. Steve, it was my pleasure.
Thank you again. Let's welcome our next guest, Alex Green. He's the investment director of the Oxford Club, a 30-year veteran of Wall Street, a 3-time New York Times best-selling author, and one of the single best stock pickers I've ever known. Welcome, Alex.
Hey, Steve, thanks for having me.
It's a pleasure to have you. The topic is taxes. You're the ultimate guru for the small investor. Why should the small guy be concerned about these new laws and the implications? I mean, do they have enough money to even make a difference?
Yeah, if you have any money to invest at all, you should very much be concerned with taxes, because investment success is only measured one way. It's maximum total return after costs and after taxes. And a lot of people think, well, I don't like the taxes, but there's nothing I can really do about it. And that's not the case at all. By following a couple of simple, straightforward rules, you can absolutely minimize the tax bite on your portfolio, or even eliminate annual taxes forfeited to the IRS every year.
Okay, we're going to get to some of the things that you can do in a minute, but I want to put a chart up on the screen that you brought with you. It shows a $250,000 portfolio, which is above average for the average guy to have in his IRA or 401k. But with the right moves, with the right planning, you say it can be $2 million or $3 million or $6 million. How does that? Walk us through it.
All right. This chart starts with a $250,000 portfolio. One of them is tax managed. In other words, we're minimizing the effect of taxes and expenses on the portfolio. The other is non-tax managed. Now, here's how we arrive at these numbers. First of all, the money on both sides is compounding at 11%, which is the long-term average annual return of the stock market. But on the non-tax managed side, we're forfeiting 2% every year to taxes, which is the average according
to... 2% sounds low to tax.
Yeah, but remember, if the stock market returns 11% a year and you give up 2% to taxes, that's actually almost 20% of your annual return every year. So it's making a huge long-term difference. So on this chart, what I'm doing is I'm comparing keeping your taxes and your cost minimal versus the same return, 11%, and paying 2% in taxes and 2% in costs, which is according to a Vanguard study is what the average investor pays. And you can see that over time, whether you're looking at 5 years, 10 years, 20 years longer, you can see the difference is enormous in what your net return is, what the final value of your portfolio will be. Now, if you're a smaller investor and you don't have anything like $250,000 to invest, just lop a zero off. Make it $25,000 and lop the last digit off the final return on the chart. That's the difference in what your portfolio would be. Not if you earned a higher return. If you earned the same return as the stock market, one way tax managed, one way very tax inefficient, where you forfeit so much of your return to the government.
All right, the numbers are great, but they are theoretical. How does the average guy actually get started doing this? I mean, what does he have to do to make this happen?
Okay, the first thing you really have to know is just a tiny bit about how the tax laws give you incentives to do certain things and avoid certain things. I call this your asset location strategy. Everyone's heard of asset allocation, which is dividing your portfolio up among stocks, bonds, cash, and so on. But your asset location strategy means you're taking your very tax inefficient investments like bonds and real estate investment trusts and inflation-adjusted treasuries and those types of investments where the most of the return is taxed at the rate of your income, which could be as high as 39.6%. The other things are more tax efficient, like index funds and individual stocks. Those types of investments would go in your non-retirement account. The tax inefficient assets, where you can't avoid paying the taxes on the dividends and interest and so forth that they pay, would go into a qualified retirement plan. So they're compounding tax deferred. So on the one hand, you've got the very tax-efficient stuff where the IRS has nothing to take every year in your taxable account, and the stuff that has a high tax liability is compounding tax-deferred in your retirement account. There's nothing there for the IRS to take.
Let's talk about tax-deferred for a second, because most of the costs that I'm hearing are taxes. 39.6% is insane. It's just ridiculous. But it's the reality. So what types of things should people have in tax-deferred accounts versus taxable?
Well, first of all, if you do short-term trading, and if you're good at it, then you should have that in your retirement account.
That is a qualifier, isn't it?
Yeah, it is. Well, if you're bad at it, then you're creating a tax write-off by taking losses. But if you're doing it right, you should be doing your short-term trading in your qualified retirement plan, whether it's your IRA or SEP or what have you, because all those short-term gains that you're taking are compounding tax deferred. Whereas, as you pointed out, if you do it in a taxable account, you could be paying as much as 39.6% on those short-term gains that you're locking in. So short-term trading in a qualified plan, long-term holds in your taxable account, because as Warren Buffett famously said, the capital gains tax is not a tax on capital gains, it's a tax on transactions. If you haven't sold a stock or an index fund or what have you, you don't have a capital gains tax liability. So short-term activity in a taxable account, longer-term holdings, whether stocks or index funds, especially equity index funds, should be in your taxable account.
Short-term gains, you mentioned them. Everybody wants to get rich quick. Everybody's trading, everybody's trying to do it in one trade to retirement, I always call it. Is there any way to avoid the short-term gains, the taxes on the short-term gains?
Yeah, well, the one thing is you would hold, if possible, hold a position beyond 365 days. That way you qualify for long-term capital gains tax treatment, which is a maximum of 20% versus a maximum of 39.6% for a short-term capital gain. That's one step you can take. The other step you can take is look at your portfolio at the end of the year. If you have losses that you can take, realize those losses to offset the gains that you have and thereby lower your annual tax liability for that year.
I have to ask this question. I know there are people out there that consider it unpatriotic to avoid taxes. I'm a Navy man. I'm a disabled vet. I bleed red, white, and blue. But I avoid all the taxes I can. But can you, for the benefit of the people out there who might be thinking this way, can you explain the patriotic element of taxes?
There's nothing the least bit unpatriotic about this, nothing the least bit questionable about this. Any accountant would look at what I've just suggested and said there's nothing shady, there's nothing dishonest. The tax laws are set up. Congress created them to give you an incentive to do certain things and to avoid doing certain things. The problem is a lot of people say, taxes, they're just a fact of life, I can't avoid them. But with a little bit of tax planning and with a tax management strategy, you can dramatically lower those costs. And there's nothing at all, there's no citizen has a duty to pay as much as possible to the Treasury. The tax laws exist for you to use them for your benefit, and it's a waste to be oblivious to the tax ramifications of what you're doing in your portfolio. With a little bit of common sense and a little bit of discipline, you can reduce your tax liabilities dramatically and thereby greatly increase the total return on your portfolio over time.
I think 39.6% is a little bit more than a waste.
Yes, it's a heaping helping.
It is. Any final recommendations, anything our people should be thinking about?
The main thing is take the time to understand the most basic parts of the tax code as an investor. You want to have tax-free bonds in your taxable account. You want to have high income, dividend-paying assets in your tax-deferred account. Individual stocks, you can control your capital gains tax liability. Mutual funds, especially index funds, should be in your taxable account. Actively managed funds, which distribute capital gains every year, should also go into your qualified retirement plan. But really, and I go into more detail on this in one of the white papers that we offer, you're really better off with long-term owning index funds and not actively managed funds anyway. So rather than saying you own the actively managed fund in your retirement account, you really shouldn't own them at all.
All right. Thanks so much for being with us. It's always such a pleasure.
Thanks for having me, Steve.
And check out Alex Green's best-selling book, The Gone Fishing Portfolio. Get wise, get wealthy, and get on with your life. I believe today we've seen the serious problems the country and all of us are facing. But more importantly, our guests have provided actionable advice for you to take to protect and grow your wealth regardless of what happens in Washington in the coming months and years. But we've barely scratched the surface here. That's why we've prepared a full program we'd like to send you today. We call it the Wealth Survival Toolkit, Tax Slashing Secrets to Outsmart Big Government's Money Grab. First, Scott has spent the better part of the past 20 years perfecting the best ways of beating Uncle Sam in the tax wars. And now he's captured all his in-the-trenches tax-beating experiences and strategies in writing. This comprehensive collection, authored and assembled by Doc Brown with Jack Cohen, covers in depth not only what you need to do to win the battle against higher taxes, but how to do it. You'll also get an easy-to-follow quick start guide that will save you time as it saves you money. This guide will help you quickly and easily pinpoint the top strategies and solutions for your specific situation and which will benefit you the most. Yet there's more still. We've arranged for Jack Cohen or one of his personally trained experts to review your personal or business tax returns in search for the best strategies for lowering your tax bite. Jack gets up to $950 alone for this service, but you'll get it free with this program. Remember, you can put your wealth in the hands of yourself and your CPA, or you can get the best tax saving and retirement boosting ideas straight from some of the top experts in this country. Just one of these powerful ideas and recommendations could save or make you thousands of dollars. Now, I'm not going to go into some big sales song and dance here. As I said, the advice in this program could save you a fortune in just the next few months alone. But today, we're offering it at the special rate of just $99. And we're offering this to you at absolutely no risk. If you're not totally delighted with everything in this program over the next 60 days, just let us know and you'll get every cent back. And for acting right now, we'll also add in a special bonus. We'd like to send you a one-year subscription to the Oxford Communique. This is a flagship publication of the Oxford Club, free of charge. In it, you'll get powerful investment ideas from my colleagues, Alexander Green, Mark Lichtenfeld, and many others, not to mention yours truly. The regular price is $129, but you'll get it free when you sign up for our Wealth Survival program today. So that's the offer, potentially thousands of dollars in actionable advice and recommendations for protecting and building your nest egg over the next year. A tax consultation worth nearly $1,000 and the Oxford Communique. And you get it all for just $99. I urge you to register for the Wealth Survival program today so you can protect yourself and your loved ones from the big tax squeeze ahead. You deserve a financially secure future.